Have you ever pondered the domino effect a single tax change could have on the entire economic landscape? Picture this: a proposed increase in the capital gains tax rate to a staggering 44.6%. This isn't a mere hypothetical scenario. It's a reality that could potentially unfold in the United States, and it's set to be the highest rate in over a century. This proposed increase by the Biden administration has been a topic of fervent debate, stirring the waters of the investment world, particularly in the stock and real estate markets. The plan is to raise the federal tax rate on long-term capital gains and qualified dividends to 44.6%. In states like California, the combined state and federal tax rates could reach a jaw-dropping 59%. These figures, when coupled with the additional burdens of state taxes in other high-tax states, are indeed startling. The fear that's been kindled in the hearts of investors is palpable. The concern is that this tax increase could spark a significant sell-off in markets as investors rush to liquidate assets before the changes take effect. The result? A potential downturn in the stock and real estate markets, which could be especially problematic for real estate investors who might face a dual hit from both the increased capital gains tax and the existing limits on tax write-offs for personal residences. The potential implications go beyond just the investment world. Critics argue that the increase could discourage investment at a time when the U.S. economy is already grappling with inflation and other challenges. Higher taxes could lead to reduced capital deployment, decreased foreign investment, and an increase in tax avoidance strategies, potentially stifling economic growth. However, every coin has two sides. Supporters of the tax increase argue that it could help address income inequality and provide much-needed revenue for government coffers. Yet opponents counter that the potential long-term damage to the investment climate and overall economic health might outweigh these benefits. Looking ahead, investors and businesses might start scanning the horizon for more tax-friendly states, or even consider relocating operations internationally to mitigate the impact of these proposed changes. Additionally, the potential for increased use of legal and financial counseling to navigate the new tax landscape suggests that the wealthy may be able to shield their assets more effectively than the average taxpayer. This proposed tax change is just one facet of a broader fiscal policy shift under the Biden administration, aiming to tackle wealth inequality. Yet, it also raises critical questions about the balance between fair taxation and fostering an environment conducive to economic growth and investment. The outcome of this legislative change could define the economic landscape for years to come. In summary, the proposed 44.6% capital gains tax rate would be the highest in over a century, potentially impacting investment behaviors and the broader U.S. economy. While the proposed change could address income inequality and boost government revenue, it could also discourage investment, decrease foreign investment, and increase tax avoidance strategies. The potential long-term damage to the investment climate and overall economic health might outweigh these benefits. The outcome of this legislative change could define the economic landscape for years to come. Remember to like and subscribe, and always stay informed.